Hello, fellow Rebel Capitals. Hope you're well. So, we've got a lot to go over today. Later on, we're going to do a video on how the market's crashing, how yields are behaving, let's say, or how yields are reacting, why this is going on. We're going to try to connect some dots. But before we get into that video, I want to talk more specifically on what is happening to the dollar. It's down another 1% today on the DXY. Now, this is a huge move. It is almost unprecedented. And notice I said almost, because we have seen moves like this in the dollar when we have a lot of market volatility to the downside. And we also see interest rates going up. Unfortunately, we have only seen this happen in times of great distress, let's say, such as the cerveza sickness and such as September, October of 2008 during the GFC. But I think the bigger question right now that people are asking is, number one, are all of these foreigners dumping their treasuries, therefore dumping dollars? And is this the end of the dollar as the global reserve currency? And if so, does that mean this is the beginning of the dollar crash that everyone has been predicting? And I see people in the chat talk about my good buddy Peter Schiff, and obviously Peter has had this position for quite some time. And I've got a ton of respect for Peter, but on this specific point, I have some disagreements. I see things differently, let's say. So what I did on Saturday, if you guys tuned in for that, or if you didn't tune into that, I actually went through kind of a debate with Chat GPT. Honestly, I didn't think people would like it at all, and people loved it. So I thought what we could do today is go through a quick debate with Chat GPT and have Chat GPT take the side of, let's just say, Peter Schiff in this argument, where the dollar is going to crash, and I will go ahead and take the side of the dollar will not crash. And whether it remains the reserve currency is a completely separate issue. But I think that the narrative is that if the dollar is losing favor, if foreigners are dumping dollars, if they're choosing to hold something else in their reserves, if the dollar is losing reserve currency status, then by definition, it means the dollar is crashing. And that isn't true at all, because the way the monetary system is set up. So we'll just focus on the dollar crashing right now, that in this little debate that we have with Chat GPT. So let me just really quick make sure our settings are right, because I forgot to do that at the beginning. Yes, they are. Okay, cool. So let's go over, and here's the prompt. And on Saturday, I typed in everything, and everyone was telling me, oh, George, you can just talk. So today I'll try to talk my responses directly to Chat GPT. And this is the 4.0 version. I know we pay for it, so it should be kind of the upgraded on the free version. So here's the first prompt that I wrote, and then again, I'll try to use voice prompts to speed up the process here. Okay, let's do a debate on the future of the dollar. We'll use the DXY as a proxy. You take the position of a top expert in global macro that believes dollar will continue to crash below 90 on the DXY, and I'll take the position the dollar will not fall below 90 and will soon bounce back into, let's say, 100 plus range. Please use every resource possible to win this debate. And to be clear, use the highest, most expert level argument possible. That's kind of our starting point here. So, and by the way, at the end of this video, I want to go over where George Gammon, forget ChatGPT for a moment, but where George Gammon will change his mind. At what point, because I think this is something every investor has to do. And this is one of the things that I really harp on a lot of the gold bugs and the sound money people that have had this view that the dollar is going to crash for so long, or the treasury market's going to blow out or something like that due to the debt or the deficits. I'm like, look, this hasn't happened for 40 years or more. And it's not, so my argument isn't that since it hasn't happened, it will never happen. But my argument is, if it hasn't happened and your models have been wrong for 40 years, you got to change your models, or at least you need to re-examine them. Just saying, well, my models were 40 years early and it just hasn't happened yet, but my models are correct. That's nonsense. That's total nonsense. So I don't want to do that. I never would want to do that. So I have a model that I'll be going over here with ChatGPT on why the dollar won't crash. But at a certain point, I'm going to have to say, okay, wait a minute. Maybe my model is incorrect. And maybe I need to re-examine my model. And I can assure you that's not going to happen after 40 years. That's not how George Gammon operates. That will happen within months at the most. And I've got specific lines in the sand that will determine that and determine when I'm going to re-examine my model to see if I got something wrong. And I'll go over that at the end of this video. So let's start here with Mr. GPT. He says, great, let's kick off the heavyweight debate. You're arguing, okay, he's just reiterating. Macro debate, will dollar crash below 90? Opening statement, dollar bear thesis. Let's start with the structural view. The dollar is deeply flawed, or the DXY is a deeply flawed metric, but as a proxy for, yeah, okay, we get that. It's dollar yen, okay. Structural twin deficits, fiscal and current account. So this is an argument that a lot of the people in the, I'll just call it the dollar crash space, or the team dollar crash. This is what they'll say. And it's not just Schiff. I mean, Gunlock brings this up all the time. In fact, my favorite investor of all time brings this up. That would be Jim Rogers. Stan Druckenmiller brings this up. The problem there is if you read the Market Wizards books, you know that Stan Druckenmiller was also talking about this in the early 90s. And his predictions didn't come true. So my point there is that even Stan Druckenmiller didn't change his model. He still has the exact same model that hasn't panned out. And he's the greatest investor, at least of our generation. So again, I want to emulate what I think he does right. I don't want to emulate what I think he does wrong. And that's, again, not re-examining his model if his model is incorrect for long periods of time. Okay, and most people's model that are in the dollar crash space start with this. And so I think this is perfect that ChatGPT is bringing this up. So bottom line is twin deficit. That means that the government is got a budget deficit and they have a trade deficit. So the budget deficit is, all of this money printing is going on. And then because of the trade deficit, the dollars go out into the global economy and they can circulate, and we're pumping out more dollars and more dollars and more dollars, which just increases the supply of the dollars that are circulating. And therefore the dollar has to go down. This is basically the argument. But here, I'll read the key talking points here. U.S. is running fiscal deficits north of 6% with no end. Full unemployment economy. Simultaneously, the current account deficit remains persistently above 3% GDP, indicating the U.S. is importing far more than it exports, a direct weight on the dollar. The twin deficit model shows the persistent imbalance in both fiscal and current accounts lead to current depreciation. Historically, when the twin deficits rise above 8% of GDP, the DXY tends to weaken meaningfully. See 2002 to 2000. Okay. Already he's completely, or Mr. GPT is completely derailed. But this is really good because it shows you what not to do, regardless of what you can agree with me or you can take Mr. GPT's side in this debate. But this is a perfect example of what not to do. Number one, don't cherry pick data. Because if Mr. GPT stopped right here, I would immediately come back by saying, okay, well, what have the twin deficits done since 2008? They've gotten bigger. And what has the dollar done? It's gone straight up. So you can't just say, okay, because there was a correlation during this period, 5-year period, and then completely ignore the 40 years. No, this is nonsense. This is very weak thinking on Mr. GPT's part. But let's keep going here. De-dollarization. Okay, so his argument is just on the demand side. Central banks are reducing. Yeah, we all know this. SWIFT alternatives, China, the BRICS currencies. Yes, of course. Their argument is that everyone is dumping dollars. No one's going to use the dollar anymore. We're all going to go over to this BRICS currency. And maybe we will. Maybe we will. And you'll notice my position on the dollar really doesn't come from the demand side. I mean, I can make an argument that's demand driven, that demand for the dollar moving forward will stay the same. But my main point is not to sit here and argue that all these countries are going to continue using the dollar because we've got the strongest military, because because they have to, blah, 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 blah. No, my argument, now, I can make that argument, but my central argument is the supply side. It's the supply side. And what you'll notice is nobody ever talks about that. Isn't that weird? Like, I'm sure you guys have seen debates on the dollar. And does anyone ever talk about the supply side? No, it's just demand side. It's just demand's going to stay strong because whatever, or demand's going to weaken because no more central banks are going to use the dollar and it's run its course and everyone's going to move on to something different. And then they just go back and forth and back and forth and back and forth like a game of ping pong. And I think that's really missing the forest for the trees. Like, that completely ignores the elephant in the room. And again, that is the supply side. And if you do hear someone talk about the supply side, they talk about it strictly through the lens of the Federal Reserve. Like, oh my gosh, we're going to have a massive, a deluge of supply of dollars because the Fed is going to print up all this money to buy treasuries and monetize the debt. That's pretty much the extent of the supply side argument that you get. So it's looking at the whole entire global monetary system through the lens of a central bank instead of the network of commercial banks that really, at the end of the day, control the amount of dollars that circulate, especially outside of the United States. All right. And we're going to be hitting Mr. GPT with some of that here in a moment, but just want to summarize his argument. U.S. real rates are not sufficient to attract flows and demand side stuff. Bonus wild cards, the U.S. Fiscal dominance, QE. Okay. CBDC experiments developing around the world. Here is his best argument by far, CBDC. Now, I have said, and you guys that are kind of OGs on the channel, I'm sure you remember me saying this. It's where I become, based on my model as it is today, where I would become a structural dollar bear is if the entire system changes. I'm not saying that just because the dollar hasn't crashed the last 40 years, it won't crash in the future. A lot of people think that's my position. Not at all. My position is if the monetary system stays the same, and then a lot of people think, oh, well, the monetary system is changing because we're going to a BRICS currency. That's not what I'm talking about. That's not what I'm talking about. I'm talking about the monetary system has to change to the point to which the majority of dollars that were circulating in the global economy were not lent into existence. So that would be Argentina. What's the difference between the Argentinian peso and the US dollar? Well, there's a few things, but in my view, the most obvious is the majority of dollars are lent into existence and the majority of Colombian pesos are printed. Therefore, if you have a printed piece of paper in your pocket, you give that to someone else, it doesn't disappear. But if you have an electronic commercial bank deposit liability that's called a dollar, and you use that to pay back a loan, guess what happens? Poof, it's gone. You see, so the supply of dollars, or any currency, if the majority is lent into existence, the supply can go down. The supply does go down with demand. Where if it's printed, if it's just green pieces of paper floating around, obviously the supply didn't go down, does it? So if the demand goes down, supply will not go down. And then what do you get? get Argentina. Get Argentina or Weimar or whatever. Okay, so let's get back to this here. So if you guys have heard my videos on CBDC, you know that the central component there is that they take on retail and non-bank accounts onto their balance sheet. And that's when they could create dollars, actual, not just base money, but broad money that's circulating that has nothing to do with debt. And maybe we'll get there, but that's not the way the system is set up now. Okay, so they say bottom line, the dollar remains structurally overvalued, currency propped up by the inertia. The moment inertia gives way, we're talking about demand, whether via reserve status hit, structural capital outflows, or coordinated foreign monetary tightening, the DXY goes below 90. Okay. So, oh yeah, that's right. Let me do a voice thing here. Let me just go back. Structural, oh, twin deficits, right. De-dollarization, okay. Okay. Allow this time. First of all, regarding the twin deficits, this does not apply, or you shouldn't have used this because you're cherry picking data. You're looking at 2002 to 2005, and if you, or 2007, and if you just look past QE, let's just say from 2008 to today or to 2020, you see that the twin deficits actually increased, but the DXY actually went up. So if we zoom out and look at the last 40 or 50 years, we see that there is no correlation whatsoever between the twin deficits and the DXY. If anything, there's an inverse correlation. So that is a moot issue to begin with. Number two, what you're talking about is the demand for dollars going down. Now, if the demand for dollars goes down, then the supply goes down potentially even faster because most of the dollars that are outside of the United States were lent into existence. Therefore, if you have more loans being paid off than are being created because there's no more demand for dollars and therefore no more demand for dollar loans, then the supply is going to go down. But yet there's still the bid for the dollar. Now, assuming that we do have all of this volatility in the global monetary system, which is what you're implying, we will see dollar liquidity go down and we will see the velocity of dollars also go down. And who this impacts is basically the balance sheets of the dollar, of the people who have the dollar denominated debt that was created by lending those dollars into existence to begin with. So what's going to happen is those entities that have the, let's say, 75 trillion in dollar denominated debt are going to have to sell whatever is on their balance sheet to get those dollars that used to be easier to come by as far as cash flow before people started, quote unquote, de-dollarizing. And the only way they're going to get those dollars to pay down the debt is by selling whatever they can on their balance sheet, which is likely going to be denominated in another currency, if not that other currency to begin with. And what you'll have happen is they will sell those, let's say, XYZ currency on their balance sheet that they have cash flow in to buy the dollars to pay down the debt. And when they pay down the debt, of course, this reduces the supply even further. So if your argument strictly revolves around demand, you're going to have a tough time in this debate because if demand goes down, then the supply of dollars will likely go down even faster, which would put upward pressure on the dollar, not downward pressure. Okay, so I've never done the voice thing here. Let's see if that works. Okay, so what it did is it, okay, yeah, so it turned what I said into text, and then I have to hit return. Okay, so he says, excellent rebuttal. Rebuttal to your point, twin deficits moot, no correlation with DXY. You're absolutely right to highlight post 2008 period where DXY rose despite growing twin deficits. That's not cherry picking, that's vowed long-term trend. But there's counter argument. The post 2008 dollar strength was an anomaly driven by three non-repeatable global imbalances, not proof that deficits don't matter. Okay, well, again, were the twin deficits decreasing? Before 2002, we could go back to a chart and I could show you that again. There's no correlation. Eurodollar system contraction, synthetic dollars short. After 2008, the global banking system deleveraged hard. As Snyder points out, the Eurodollar system was broken, creating a synthetic short for dollars. Or a synthetic short on the dollar. Foreign banks and corporates scrambled for dollar liquidity to meet obligations. The bid for dollars was not a vote of confidence. It was a sign of structural plumbing failure. It created upward pressure on the DXY, but this isn't 2010 anymore. The forced bid dynamics are decaying as global credit growth slows and banks step back from dollar intermediation. See, now what ChatGPT is doing is he's understanding that he has no argument because what he's doing is he's just making my argument for me and restating it and repackaging it as though he's somehow proving his point. Look, this last sentence, but this isn't 2010 anymore. Those forced bid dynamics are decaying as global credit growth slows. Dude, you're making my point for me. If global credit growth slows, then that means there's less dollar loans being created than there are being paid off. And that means supply of dollars goes down. You see how even with Mr. GPT here, because he's just mining all of the other debates or, all the other data points on the internet, you can see by just with the response here, how the argument just almost always revolves strictly around the demand side. Because what he's saying is that, the global credit growth is slowing down. Banks are stepping back from dollar intermediation. Like, okay, demand for dollars is going down. Look, the banks are stepping back from dollar liquidity. Okay, that's not dollar bearish. That's dollar bullish. Why? Because the supply, there's no more supply. And I don't know why. I don't know why people get fixated on the demand side of the equation so much. China's growth model peaked, the Europe flatlined. The dollar gained strength not because U.S. fundamentals, but because everyone else looked worse. Europe flirted with deflation. Okay, but this is a demand side argument. Come on. This is just the exact same stupid argument regurgitated in different ways. Reserve recycling kept the bid alive from 2008 2020. Massive U.S. deficits were recycled via reserve accumulation by EM central banks. They bought treasuries and parked them at the Fed, creating and by now, guys, you don't need me to see the flaw in this argument. It's the exact same thing. It's the exact same demand. We had all this demand because EM central banks took their excess dollars and recycled them into treasuries. But now we don't have all this demand. And then the EM banks are going to buy gold, and therefore they're going to be selling their dollars. That's okay, great. So they're going to be selling their dollars. Fantastic. Where did they get the dollars? Where did all of these central banks that are selling their dollars, that are dumping their dollars right now, assuming they are, where did they get those dollars? Where did those dollars come from? Did they just fall out of the sky? Were they printed? No. They were lent into existence. So if this is an asset on the central bank's balance sheet, they can go ahead and sell, assuming they are, then it's a liability on someone else's balance sheet where they need those dollars to pay off the debt. Let's keep going. His rebuttal to demand falls, supply falls faster. This is nuanced and extremely sharp point. You're invoking dollar short squeeze thesis. Absolutely real. You said blah, blah, blah. Okay, here's his rebuttal. Roll risk forces liquidation at the wrong time. Yes, debt payment, pay down destroys dollar supply, but in periods of global stress, entities can't pay off the debt. They have to roll it. GPT, how are they going to roll the debt if, to your earlier point, where is it here? Banks step back from dollar intermediation. So you're sitting there saying that we're going to be dumping dollars. No one wants to deal with the dollar anymore. Therefore, the liability side of the dollar or of the banks is going to decrease as far as a percentage. But yet somehow they're going to want to continue to create all these dollar loans. Huh? That doesn't make any sense. If we have the banks step back from dollar intermediation because demand for dollars is increasing or decreasing, that means that there's fewer loans. There's less dollar liquidity. In other words, less of an appetite from the banks and less of an ability because they've got to match up the liability side of the asset side. They don't want to take that FX risk. So there's less willingness and less ability for these banks to go ahead and roll over the debt. And by the way, who wants to roll over the debt if none of your cash flows are in that debt again? And here's, I should tell this to Mr. GPT here, but this is more about you guys. You can put this in real world context that everyone can understand. Let's assume right now you live in the United States. Would you agree to be paid right now in Swiss francs or Mexican pesos? Would you agree right now to be paid in Mexican pesos or Japanese yen? Most of you, and I'm not talking about part of your paycheck, I'm talking about your entire paycheck, entire thing, 100%. Would you be willing to be paid in Japanese yen if you live in the United States right now? For most of you that actually need that paycheck to pay your bills, you're going to say no. And that's a very logical answer. Why? Because when you go down to the grocery store, you can't give them yen. When you pay your rent, when you pay your mortgage, your car payment, you can't pay them yen. All that stuff is denominated in dollars. Right? Therefore, if you had, let's just say, a mortgage, would you roll that over into what would be the best example? Would you, let's assume that you are being paid in yen, that your employer forces you to be paid in yen. The next time you go to roll over your mortgage, would you roll it over in dollars or would you switch it over to a yen loan? You'd switch it over to a yen loan because you don't want to take the FX risk. You don't want your expenses to be denominated in one thing and your income to be denominated in something else. So let's assume that when you did roll it over, you rolled it over into a yen loan to match up your income. Or in this case, with a global corporation, your cash flows. Then what would happen is you would borrow the dollars, right? That would pay off the loan. And then you would take out another loan to replace it that was yen denominated. Actually, you would take out a yen denominated loan based on the current FX rate versus the dollar, and you would basically borrow those yen to eliminate your dollar loan. And in doing so, if you eliminate that dollar loan, then what's happening? You're actually reducing the amount of dollars that are there. So what you'd have to do is you would first and foremost, I'm just thinking this through out loud here. If you had the dollar denominated loan, you'd first and foremost have to pay down that you'd have to pay that down to nothing. So you would have to get those dollars somewhere by selling assets on your balance sheet to get that balance down to zero. And then you would have to take out another mortgage against your house that was denominated in yen. That's how you would do it. And that process of you paying off that loan, and why does it do that? Because let's say you have $1 million loan, and that's what you have to pay to get rid of this thing, so that you can then take out that yen loan against your house, and then match up your income with your expenses. So what you would do is you'd collect all these dollars, and you would have people transfer money into your bank account, right? Until you got up to $1 million. And then you'd say, okay, bank, I'm ready to go ahead and pay you. And then the bank would take your balance from 1 million down to zero. That's where the dollars disappear and they're no longer there. So that's the process here. So again, what Mr. GPT is doing is he's contradicting himself. So what do I want to do here? Doom loop of liquidity lasts until credit market freezes. The Fed intervenes, swap lines, global plumbing. Jeez. Okay, here's where I'll go with this. In your first response, you talked about global banks backing away from dollar intermediation. And I would assume that you're talking also about dollar credit creation. And this makes sense in a world that was de-dollarizing. But then as you continue with your response, you talk about all of these entities rolling over their dollar denominated debt and therefore the supply not going down. If global banks were less incentivized, had less ability and less willingness to create dollar liquidity, then by definition, that would make it harder, if not impossible, for those entities to pay off or roll over their existing debt. Therefore, we go back to what I was saying at the beginning, where these entities would have no choice but to sell whatever currency they had on their balance sheet to get the dollars to pay off the dollar loan. And then they would go ahead and take out another loan in a currency that matched up with their cash flows. So, as an example, if I am a Japanese bank, or if I'm a Japanese multinational corporation, and currently most of my inputs are denominated in dollars, I can go ahead and take out a dollar loan, but then I'm going to have to collect those dollars through cash flow. If fewer of my customers are willing to pay me in dollars, therefore my dollar cash flow goes down, I am taking FX risk with the debt that's on the liability side of my balance sheet. I don't want to do that. So I'm going to pay off that dollar debt as soon as I can, reducing the supply of dollars. And then I'm going to replace it with a yen denominated loan, assuming that the majority of my cash flow is coming in yen because no more of my customers want to use dollars. So what you're doing is you're just taking these demand side arguments and you're repackaging them in different ways. But the conclusion is still the same, that if dollar liquidity is drying up as a result of de-dollarization, if these banks are stepping back from not only intermediation, but credit creation that's denominated in dollars, you still have the problem of more debt when you add the principal plus interest existing on balance sheet than currency units or dollars available to pay that. Therefore, the only way that those debts can get paid is if you are creating more dollars through lending than are being paid off, and if the velocity increases at a sufficient rate. But every one of your arguments would result in fewer dollars and less velocity, which ironically would make the dollar go higher. Basically, every one of the points that you're making is a bull argument for the dollar. It's not a bear argument. Okay. He says, fantastic. You're hitting the deepest levels of the dollar system mechanics. We're now in Jeff's. I didn't tell him to talk about Jeff, so I don't know why he's doing that. And this is a brand new threads. And I don't think that I've really, in other threads, I don't know that I've really talked about Jeff. So this is just, I told GPT at the beginning to, do this at an expert level. So I'm assuming, and it's not that Jeff is the foremost absolute expert. I think there's people from the IMF that are at his level. Manmohan Singh, as an example, and there's a college professor, Perry Merling. I believe it's MEHRLING, something like that. And he is absolutely fantastic as well. But I think that those guys are more behind the scenes. So that's why GPT is just going straight to Snyder, because more of his stuff is public. Okay, he says you're right about dollar loans being replaced, not or repaid, not replaced. Shrinking euro-dollar system, FX mismatch problem, velocity collapsing. Why DXY still falls? The bull case for the dollar doesn't show up in DXY. Let's zoom in. Okay, so now they're really grasping at straws here, because I told GPT at the beginning that I want to focus this debate around the DXY. But obviously what he's doing is he's realizing that he can't win this debate. So now he's saying, well, the DXY, let's remember that it's really euro, Japanese yen, and British pound. And that, oh, look, a squirrel. Same thing he did on Saturday. So he says roughly 83% of the DXY basket, euro, yen, pound, none of which have dollar debt problems like the EMs. Okay, so I'm sorry, he's positioning a little bit different. And most of the global dollar debt mismatch exists in ME. Okay, there he is right to a certain degree. It is true that they have less of a dollar problem, but they still have a dollar problem. Insights, even if there was dollar shortage globally, if it's not acute in Europe or Japan, the DXY doesn't rise. Dollar credit collapse, balance sheet deleveraging. Okay, here's where Japanese banks rely on dollars. They sell yen for USD, yes. But what if the dollar asset they held US Treasury or Apple stock, that isn't bullish for the USD? Selling USD assets, this is nonsense, because they're just going back to the same argument. What happens if dollar debt can't be rolled and is defaulted? Oh, come on. This is the most ridiculous argument of all time. A velocity argument, more nuanced in a QE world. QE doesn't increase velocity. Okay, so he's really grasping now. We got him on the ropes. Okay, so first thing here, what does he talk about? He talks about dollar credit collapse, Japanese liquidation, balance sheet deleveraging. Oh, he does make a good point about the fact that EMs have more dollar-denominated debt. Okay, let's address that first. And then, default. That's child's play. And then QE. Okay. You're correct to bring up the point that it is a bigger problem in emerging markets as far as the dollar-denominated debt, but that doesn't mean that it's exclusive to emerging markets. The problem exists within Japan, within Europe, within Asia. Why? Because the global monetary system, which is dollar-based, is a network of bank balance sheets. And like a Jenga puzzle, like the Jenga puzzle that they highlighted in the movie The Big Short, if all of these bank balance sheets are interconnected in this network, which they are, regardless of whether those banks reside in Brazil, in an emerging market, in Europe, in the Cayman Islands, it doesn't matter. The geographical location is completely irrelevant. What really matters is the fact that they're all interconnected, therefore have the systemic risk that is implicit in their balance sheet management. And let's remember that the debt doesn't exist really at a sovereign level. The debt exists on the balance sheet of multinational corporations that are geographically tied to, let's just say, Brazil or an emerging market. But what happens is it doesn't mean that that multinational corporation got the dollar loan from a local bank. As an example, a Brazilian multinational corporation could have got that dollar loan from a bank in the Cayman Islands that is also extending euro credit to another bank in the UK, in London, more specifically. So my point is, if that Brazilian multinational company struggles to repay its dollar debt because of the arguments I've made in this debate, then what's going to happen is they could potentially default on that loan, or at the very least, the risk to the Eurodollar bank that created the loan to begin with in the Cayman Islands is going to increase. So if the risk increases to that bank because of who they've lent to in the emerging markets, then they're obviously going to decrease dollar liquidity moving forward. They're going to shore up their balance sheet. They're not going to expand their balance sheet. They're going to use their internal risk management models to, if anything, decrease the size of their balance sheet to take risk off the table. So the main point here is that regardless of where what geographic location the dollar denominated debt resides, it still was created to begin with by the banks in the Eurodollar system, and all of these banks are interconnected. So looking at it through that lens, it's not just that the Eurodollar banks' balance sheets are all interconnected. By extension, all of the entities they've lent dollar loans to are connected to their balance sheets. Therefore, all of the balance sheets of the multinational corporations are connected via the monetary system and via the network of these global Eurodollar banks. That's first. Second, what happens if the dollar debt can't be rolled over and is defaulted on? I'm glad you brought this up, because what is a dollar at the end of the day? The only thing a dollar is a commercial bank deposit liability. Notice I said the word and emphasized the word liability. So if banks are defaulted on, or if their loans, the asset side of their balance sheet, in other words, is defaulted on, then what happens? Then they go bust. And let's remember that it's very unlikely that some of these banks in the Eurodollar system go bust, and the Fed or central bank comes in to save the day, because these banks operate outside of the purview of the central banks. So if XYZ bank goes bust, then what happens to their liabilities? Their liabilities are gone. Well, if dollars are just simply bank liabilities and the banks go bust, then that reduces the supply of dollars even faster than the banks not creating more dollar liquidity. So again, this is not an argument for the dollar going down. This would be an argument for the dollar going up due to the supply decreasing at a faster rate. And let's assume for a moment the banks don't go bust because of this default. At the very least, this increases their risk. They're going to shore up their balance sheet, and they're going to lend less. And in this environment, of course, there's going to be more loans being paid off than are being created, less dollar liquidity, less velocity, and therefore dollar goes up. The next thing you talk about is velocity actually increasing due to quantitative easing. But again, this is just complete nonsense. If you actually look at the velocity, not just in the United States, but globally during QE 1, 2, and 3, you see that velocity didn't increase, it actually decreases. And Japan is a perfect example. Their debt to GDP, and they've been doing QE for what, 40 years? Their debt to GDP now is 230, 240%. And they have not had a problem with inflation. They've had a problem with deflation. And therefore, this just goes to show you that usually what we've seen throughout history is when the central banks get involved and when they do QE, just to put a Band-Aid over the real problem, velocity doesn't increase, it actually decreases. Okay, it's just doing a transcript here, guys, so bear with me. Okay. This is top tier macro thinking. You're applying the most nuanced framework we have for understanding the international monetary system, the Eurodollar network as a sovereign bank and bank driven decentralized ledger of credit. You're absolutely correct. It's not about geography, it's about balance sheet connectivity, dollar credit channels, and the health of interbank trust. So he's talking about where that we agree, core disconnect. You're analyzing supply as dollar bank liquidity. That's crucial for understanding. Okay, you're just agreeing with me more. But the DXY is a price, not a quantity. It's relative exchange rate index, heavily skewed. Okay, we already talked about this. So here's the crux. You can have global dollar shortage and still see how. Think about, now he's really grasping. He says you can have global dollar shortage and still have DXY fall. If if the other currencies are being supported by tighter monetary policy, therefore, what they're a repatriation of capital. So what he's talking about here is interest rate differentials. So why are interest rate differentials a thing? Why do people talk about them in terms of FX cross rates? Because if you have higher interest rates over here, then theoretically that's going to suck capital into these markets. There's going to be more demand for those currency units that those assets are denominated in, and therefore it's a tailwind for that currency. What is this, guys? It's a demand side argument. It's just the same thing regurgitated in a different way. It's the exact same little present, but it's just packaged in different wrapping paper. Okay, so now they talk about let's see, Eurozone crisis 2015, China deval 2015, Cerveza sickness 2020. And he's talking about all these DXY spikes. Again, now he's really got nothing, because he's just, every single one of his rebuttals is just proving my point. Like, look, the Eurodollar crisis, 2011, the Fed came in with dollar swap lines. Fantastic. What happened to the DXY? Oh, that's right. It went up, not down. China deval, global easing. Oh, right. DXY went up, not down. Cerveza sickness, unlimited QE swap lines. Oh, yeah. DXY went up, not down. I mean, all right. I think you get it, guys. I could go on and we could debate this, and I really enjoy this stuff. So let me know in the chat if you guys like these chat GPT debates as well. And what I was thinking, and let me know if you'd like this in the comments, is turning that into an MP3. So that whole thing, instead of me just summarizing it, turning it into two voices that were debating this back and forth, just like you heard it on a podcast. And I can do that through AI. And then I could go ahead and upload it to the Rebel Capitalist Interviews podcast, and you guys could just listen to the audio version of two voices, basically reading in a conversational tone the debate that we just went over. So just let me know if you guys would enjoy that, and just so you can listen to it over and over again, and there's not the uhs and the pauses, and you don't have to wait. And then what you could do actually is you could take that podcast and you could take the transcript and you could upload that to ChatGPT and have ChatGPT explain it to you, or that certain areas that you weren't following, you could have ChatGPT explain it to you in more detail, whether you're coming from my position or from their position. Okay, now I want to go over what would make me reassess my models. So you guys kind of get my framework from that. And by the way, that's not the complete framework by any stretch of the imagination. I mean, we really just kind of hit the tip of the iceberg right there. Like I said, I could go on for another 3 hours, and I could give more and more and more and more and more and more talking points. That's for sure. But you guys kind of get my framework there, or that model that I've created by doing literally thousands of videos on this topic since 2019. And another thing that I said on Saturday that I'd like to highlight is, you don't have to agree with me. You can think I'm completely crazy, or that I've got the dollar all wrong, or whatever it is. I mean, everyone's entitled to their opinion. And there's a lot of people out there like Peter that I think Peter's a great guy, number one, but I've got a massive amount of respect for Peter. But I just disagree with him on this. So what? We can have a cordial, respectful disagreement on this. And but what you can't do, even if you disagree with me, is say, oh, George is just pulling this out of thin air. Oh, George, I disagree with your opinion because you haven't really thought this one through, or you haven't really researched it. Look, you can disagree with me, but you can't disagree with me because you think I'm just pulling this out of thin air as far as my opinion, or that I haven't thought this one through, or that I haven't done a lot of research on this. Hopefully you can tell just with this little debate that I've put a lot of thought into this one, and I've done a massive, epic amount of research on it. And I've come to these conclusions, and I've used all that research and thought to come up with this model. So getting back to it, how would I determine, okay, George, you know what? Your model might not be correct. And I'm happy to do that. Happy to do that. Like I said, I'm not going to get stuck in the mud on any of my opinions with using any of my models or any of my frameworks, and just double and triple down, quadruple down if I've come to that line in the sand that says, you know what, you need to reevaluate this because your model, this was not on the bingo card of the model. So let's go over to, I guess we'll start with the DXY. I'm just pulling up a chart here, guys, because I want to zoom out and I want to give some context to where we are right now, because it's easy to get caught up in the whole dollar crashing thing, because it has come down so substantially over the last couple weeks. And this is almost unprecedented. It's definitely unprecedented outside of times of just pure chaos, which isn't exactly comforting. But if we go to the all-time chart, and this goes back to 1967, you can see where we are right now. It's not, I mean, it looks like it's pretty much normal. We had this huge, huge peak here. You guys know what that was. That was where they had to break out the Plaza Accord. And then we had another big run up in, just before the dot-com bust. But I mean, we were down in the 70s during, let's just say the GFC. And so we're still not extremely high, but we're still, I would say, higher than the long-term average. Now, that doesn't mean that we're not going down further. So if you look at the support lines here, you're going to see support right at 90, roughly. So one of the first things that would make me re-examine my model is if this goes down below 90. But if it does it within a very short time frame, I would re-examine my model, but I don't know if I would be too concerned with it, because one of the main components of my argument or my framework that I didn't get into with ChatGPT was the debt is extremely short term. So if, as an example, all the debt that created this, let's just say $75 trillion outside of the United States, if all that debt was long term, like a 30-year mortgage, I would not have the view I have. In fact, I'd probably agree with Peter. But if you look at the data, and there's no specific, quantifiable stuff, but if you just look at all the BSI or BIS research and IMF and all these things, you can come to a conclusion that most likely the majority of this debt that created, let's just say, the $75 trillion outside the United States is very short term. Less than 6 months, maybe even less than 3 months. So that means that every 3 months or so, we have to roll over like 50 trillion in US dollar denominated debt. That's not just on corporate balance sheets, and that's also including obviously interbank credit and debt and whatnot. But that's the whole kit and caboodle right there. So that means that you can only have dumping of dollars for so long before those other entities have to scoop up those dollars to make those payments. You see, and if they had 30 years to do it, well, then the dollar could fall, crash until the majority of these payments came due. But if you only have 3 months, that's a whole different ballgame, isn't it? And you can take it to an extreme. What if all the dollar denominated debt was due tomorrow and therefore had to be paid tomorrow? What would happen to the dollar? It would almost go to infinity. Because again, there's not enough dollars to service the debt when you include the principal and interest. And if you don't have that velocity, at a certain point, let's take it to an extreme. At a certain point, you get to a level where there's just $1 left in the whole system. But think about how much interest would be due, even if it was short term, on 75 trillion. So you get to a point where there's only $1 left in the entire system, excluding currency, green pieces of paper and whatnot. I'm just talking about the dollars that were lent into existence. You get to a point where there's $1 left, and there's billions and billions, possibly trillions of interest that's still due. So the value of that $1 goes to infinity. That's why maturity matters so much. So my point here, guys, is number one, I'm going to be watching that DXY, those support levels. Number two, if this happens over a long period of time, like let's say it gradually comes down further and further and further and further and further and further and further, and we fast forward 6 months from now, and the dollar is at 89 or 90, then I am going, and you heard it right here first on the channel, I will absolutely reevaluate my models, because my model predicts that in a short period of time, the dollar goes down. We're going to have at least a small rebound, because those entities that are dumping, let's say, those dollars are going to have to be picked up by entities that need it to pay off that debt. Therefore, that demand bid comes in, right? And there's not going to be enough global liquidity because of everything else that's happening, global recession. There's not enough circulation of credit in dollars, and therefore they're going to have to sell whatever's on the balance sheet, and that's likely going to take the dollar back up to a level that it was before, if not maybe even higher. So if we go just down, right, over the next 6 months, and we wake up and the dollar's at 87, 88, 89, something like that, I'm reevaluating the model. If we go down to 90, let's say, or even 89, I'm going to get this is a red flag here. But then if we zip back up to 95, 97, 98, something like that, and I can totally see how we'd zip right back up to 103. But even if we're back up at 95, 96, then I'm like, the model is still within the range of the model is still, I think, consistently predicting what, although you can never get the timing right, but this is still consistent with the model and the framework to begin with, because that's just that snapback of those entities having to buy the dollars that don't have the dollar cash flow. So those are the two things. Under 90, and then, but what's most important by far is that if we stay under 90 for, let's say, 6 months, then we're going to be going through this exact same thought experiment, poking, and I'll be the first one to do it, poking holes in my model to see where it's wrong, what I got wrong, and how can I improve it moving forward based on the most recent data we have. Okay, guys, enjoy the rest of your afternoon. As always, make sure you're standing up for freedom, liberty, free market capitalism. I want to encourage everybody to get their tickets to Rebel Capitalist Live, because it's the exact same stuff that we're going to be discussing at great lengths there. We've got incredible speakers like Robert Kiyosaki, Jeff Snyder himself, by the way, Brent Johnson, and some dollar bears. I think Joseph Wang might be there. I think he's probably a dollar bear. So some good back and forth. But the best part about Rebel Capitalist Live is just meeting your fellow Rebel Capitalists. You can check everything out and get your tickets at rebelcapitalistlive.com. On that bombshell, guys, enjoy your afternoon, and we will see you on the next video.